Hey, welcome back, everybody. And today we have a really interesting character. He's in Arizona. He's the founder of Clearstream Advisors. He is also he's obviously a registered investment advisor, but he's also very involved in other positions, multiple advisory board positions. He's an advocate for food for the hungry, and he's also an author of 101 Principles to Wealth, Key Financial Secrets for Success in Planning, Investing, Savings, and Spending. That's a mouthful. Chuck Brokop, welcome.
Thanks much, Brian. I appreciate it. It's great to be here with you.
Well, it's great to have you, Chuck, and we've known each other for quite a while. And I wanted to give a chance to highlight what you know and what a great practice you run. But do us a little bit of just give us a little bit of background on what you did before you founded Clearstream, and then we'll talk about Clearstream after that.
Yeah, okay, I appreciate that. Yeah, I am actually a Chicago product originally, moved out to Arizona years ago and got into technology and was fortunate to get with a company called Cisco Systems in 1993, before Al Gore even invented the internet. So nobody knew what the internet was back then. And it was a neat time to be there. I was at Cisco from 1993 to 2005, and held various roles and positions in major account sales, business development, structured financing, had my hand in several acquisitions. And from that, had a financial background, understood how the dot-com craze was insane, educated people then, and had friends and colleagues coming to me asking me to manage their money. And so I said, well, I can't do it while I'm working at Cisco, but someday I'll leave here and start my own firm. And I ended up doing that. So that's how Clearstream came about.
Good. What do you think your experience at Cisco helped you with now that you're an investment advisor?
Great question. I think quite a few things, but centering mostly on the equity markets, it really helped me understand valuing and modeling and realizing how hard it is to truly value individual equities in the market. It's very difficult, right, to project. As Yogi Berra once said, predictions are tough to make, especially about the future. And so projecting revenue and earnings and margin and what the price earnings multiple will be, what is there multiple contraction or expansion, those things are extremely, extremely challenging.
Yes. Well, and we saw it in spades back then. I know Cisco, they were acquiring 100 companies a year or something like that. Chuck, that must have been quite an outrageous time to be with Cisco Systems.
It was, and it's tough to get those acquisitions correct. They had a lot of cash, so the board is driving them to put the cash to work, and not, you got several choices: sit on the cash, give dividends back to investors, or acquire companies that you hope that are at some point accretive to your earnings and revenue.
That was such a strange and stressful time in the telecoms industry. And I imagine if you didn't know anything about company valuations, you learned it the hard way. In Cisco, the craziness of the valuations and the dot-com bubble and buying companies off plans with no revenue in some cases. That was a really crazy time.
Well, it was insane, and I think history's proved how overvalued things were. And I'll give several examples. Cisco itself, great company, has grown revenue and earnings since that period, but it took Cisco 19 years to get back to their old high. So people got so hyped up over the stock and what the internet was going to do, and certainly the internet has lived up to its the promise of what it's delivered to society in even more ways than I think we imagined in 2000. But Qualcomm's the other one, right? Cell phones. 2000, are cell phones going to be big? Is everybody going to have a cell phone? Yes. Well, Qualcomm again took about 19 years to get back to their high of 2000, March of 2000. And a lot of people don't realize that. So you can get excited about cell phones and a company like Qualcomm, but it takes years for them to catch up. Here's another great example. streaming video was coming on in 2000. A company called Akamai, that's still around today, has grown revenue and earnings, is still not to their old high. They're about 60% of their old high back in March of 2000. Now, was streaming video big? Is video on demand big? Absolutely. Yeah. Have they grown revenue and earnings? Yes. But Akamai's stock price isn't where it is 24 years later, which
Wow.
just shocks people. And it tells how hard it is to really get these things right in the long term.
Yeah. Nice. So then you took your background in telecoms and other experience and you started Clearstream. So tell us a little bit about Clearstream. What was your thought process and how's that going?
Well, it's going well. And I'm very fortunate to have merged into FourStar, late last year and join a great team. And oddly enough, a firm that's based in Chicago, where I'm from, that wasn't by design, but it's the flexibility that FourStar offers. And the one thing I'm not and never was at Clearstream was cookie cutter approach. Just buy a basket of stocks and a basket of bonds and leave it, do the same thing for everybody. And I see a lot of firms do that and get overweight maybe in an area. So Clearstream started out really, trying to take an individual approach with people, a little tougher to do, but I think the right thing to do. And then a little more conservative approach as well, not swinging for wild, hot stocks and that kind of thing, not chasing things, but also looking at alternatives. Quantitative, I do a lot of quantitative models, some alternative meaning non-stocks and bonds. We'll do senior secured debt, things like that, structured notes, real estate funds, that kind of thing, that are well capitalized.
Nice. Well, good. Let's dig into all that. What are you seeing in the markets right now? So after we saw that crazy overpriced technology market in 2000, is it looking like that now or different?
Well, I certainly see some similarities. You get these crazes and people just throwing money at anything with AI right now, right? That's the big buzzword. And there's still a lot of uncertainty of how that is going to be monetized. We're going to be the winners, the losers. There's always winners and losers. I remember people in the mid 90s, don't recall now, but how competitive the landscape was with networking and how Cisco out executed the competition. But there was severe, and tough competition back then. And there will be in AI. And the big caveat is, how's that going to monetize? Who's going to monetize it well? We're going to be the winners, the losers. And, what jobs are going to be displaced because of it? Those kind of things. So, but I see a lot of hype, as I did with Bitcoin. Bitcoin's another one of those examples that the whole premise was scarcity, but now all of a sudden we see all these digital currencies out there. So is digital currency really scarce? No, we could start chucking Brian's coin tomorrow if we wanted to. So that busts that scarcity argument. So it's really the bigger fool theory that you have to go on if you're buying something like that, because this shirt I'm wearing has more intrinsic value than a Bitcoin. more true value. Not that it's worth a lot either. So, but it just, I see things like that where people get unhinged from a true investment versus speculation.
So Chuck, in your book, you talk about success, secrets for success, and the planning. So you must do some planning. And so what kind of planning is the key to helping an investor?
Yeah, I think there's several things. Certainly, living within your means, understanding how much you're going to earn and what you're going to keep out of that earnings. But also one of the things I talk about is measuring, right? If you're not measuring things, how do you know you're moving forward?
Right.
And companies do that. Public companies are required to do that quarterly and report that earnings statement, cash flow, balance sheet, revenues to their investors, to their owner operators. And people should do that as well. So I encourage people to do a quarterly net worth statement so they can track where they're at. Are they making money? Are they moving ahead? Are they paying off their debts? Measure those debts, pay those high interest, higher interest rate debts first. Certainly credit cards, right? Don't carry any credit card debt. Those kind of things and those principles to help people measure it and then focus on what's working, what's not, continue to do those things that are working and or save money, cut expenses out, those kind of.
Is there any one principle of financial literacy that you think would be most important for people to know?
Yes. And it's always tough to pick one, but the one I would absolutely say is protection. And I've developed defensive strategies. I'm a big believer in that because of the principle really of variance drain and recovery in a loss. So if a lot of people don't understand the principle, if you have a 50% loss, you need 100% gain to get back to break even. That's orders of magnitude greater than the loss. So if you have a 20% loss, you need a 25% gain to get back to break even. So it's those principles, right? People don't understand. If you go up 10% one year, down 10%, up 10%, down 10%, you're actually losing ground over time, and that's due to something called variance drain. So people get enamored sometimes with an average rate of return, but you can have a lower average rate of return, but steadier without that volatility and be ahead in the long run. So I think that protection and discipline is the number one attribute I would say that most important to people.
Well, great. So speaking of discipline, you've been the leader of the Trend and Defend investment strategies, and you run money on SMA basis. You've had an ETF. Let's talk about Trend and Defend. That's a very interesting concept.
Yeah, it's a quantitative model that I developed. It's proprietary, based on technical signals. I'm quite a quant, and what I wanted to develop, and it took years and years of studying the market technicals and looking at those to develop this strategy. But the premise of the strategy is to have a signal that is green and go long the market when it's green, in cash when it's yellow, and then when it's red, be defensive, but actually go inverse the market. So if the market's down 10%, it's up 10%. So you're capturing what I call crisis alpha. But with that, I love the old football coach Bear Bryant. Bear Bryant is famous for a quote that states, "Offense sells tickets, but defense wins championships." Yeah. And I think the same thing is true in investing. Don't get caught up in the highlights and the offense and the hot stock. Be defensive first. And this discipline, quantitative method, none is perfect as a trend model, but in looking back over market history of 40 years, it was red when it needed to be red in those big downward sell-offs. It's remarkable.
Yes. So tell us how that Trend and Defend works, Chuck. Are we investing in stocks and bonds or cash, or what? How does that work?
Yeah, great question. It's pretty simple. We utilize the Vanguard VOO, which is a replication of the S&P index. When we're long and green, we use short-term treasury bills when we're in cash, which are paying pretty good interest now. And then when we're inverse, we use an ETF that is a one-time inverse of the S&P, and it's through a company called Direction, and it's their exchange traded fund. So these are things that you can get in and out of very, very easily in the open market.
Okay. And so then you're either in or out, and you get signals and when to be in. How is it positioned right now?
Yeah, interestingly enough, it's positioned in cash right now.
Okay.
It's very close to going red right now. So it's in cash. And this the market is interesting today. And I said there's some similarities along with 2000. But in 2000, um, there were about 5 to 7 stocks that made up about 18% of the S&P
Mhm.
market. Now there are 5 stocks that make over 25% of the S&P market, which means, um, you'd have to have 90% of these S&P stocks move significantly to move the market. It's remarkable that it's that heavily weighted with Apple, Nvidia, and Microsoft right now, which is unusual. Even a higher percentage, of these top stocks than it was in 2000.
Nice. Well, good. So trying to defend is a good way to capture gains and then also help to avoid losses. That's the
Yeah,
point.
absolutely, absolutely, and unique in that it's one of the few models out there that captures what I call crisis alpha. So in March of 2020, uh, we ran it, and at one point it was, it finished the first quarter of the year up about 10%, um, which was obviously great relative to where the market was down. The market was down close to in the high teens at the end of the first quarter. So that delta was significant, not only in protection, but a good ballast in the portfolio.
Okay. Great. And Chuck, so if investors want to participate in Trend and Defend, it's only available through Clearstream and FourStar. Is that right?
That's correct. That's correct.
Great.
And it's
That's
on the Orion platform. So there's a model
yes.
that's accessible within that platform.
So they can call you and they can call the FourStar headquarters, and that's how we get into Trend and Defend.
That's correct.
Excellent. Excellent. Well,
Correct.
good. Well, it's a good thing for folks to consider. Um, we talked a little bit before about alternatives, and you like investing in alternatives for investors. Tell us how that works and why.
Yeah, I do. I like alternatives being non-stocks or bonds. Bonds, it's been one of the worst well, has been the worst bond market now in the history of the bond market. We've had the longest correction, and even though interest rates are coming up, what that does is pushes the bond prices down. So it's been a rough last 2.5 years in the bond market. And then we had low interest rates for so long. Um, and then the stocks are volatile. If anybody's been in stocks and owned them individually, they can go up over time, but there's volatility. And I point out to people, the S&P after 2000 took 7.5 years to get back to break even to its old high. After 2008, it took the S&P about 5.5 years to get back to break even. That's a long time to wait to recover your money. So that's why I like things like Trend and Defend, which is an alternative, but other alternatives that are non-correlated to the market. Some commodity funds are not always correlated. Senior secured debt, you're high in the capital stack with a reasonable rate of return, often in the 8 to 10% target area. With large companies, the collateral loan obligation of those big companies, some business development companies that do some lending or loaning, apartments, energy. We talked about an energy fund recently that's tax favorable. That's non-correlated to the market. Those kind of things just kind of stabilize your portfolio when other things are volatile.
Nice. So, Chuck, as you developed your business, how did you start business? Sounds like with some referrals, and then how do you develop clients now in the industry?
Yeah, I've never been a marketeer and promote myself or what have you. It's through meeting people and or referrals. Uh, Presently is how I end up have grown the business. I don't go knock on anybody's door and ask them to manage their money. If I can help them, I'm happy to help them and be a resource. But I don't do any personal marketing on my own.
Okay. So you've been in the industry now, it's almost 20 years in the financial advisory industry. And you've seen some good times and bad times. What's the most difficult time that you've seen, and how did you get through it?
Yeah, it's certainly, I would say, it was 2020, because the market came down, and it's interesting how fast uh, the S&P, the Nasdaq, and the Dow came down in 2020. It was actually faster sell-off than in 1929. So we hear about that, and of course, they didn't have the internet then. They didn't have people hitting their accounts and what have you. The transactions didn't happen as fast. So things accelerate now. Um, and so that was a tough period to see things unravel. And yet, I had clients obviously that were concerned, uh, like most people. And I said, well, I got good news. Our largest position is actually up, and that was trend and defend. So that helps calm people down. Wow, our largest position is up right now. Yes, it is. And we're doing well. So, as I point out to people, in technology, you got the bell curve, right? And those early adopters often gain the greatest advantage. Then you're kind of in that 80% of that bell curve. You're just kind of with everybody else, whether you're using the fax machine, the internet, Federal Express, all those things that can accelerate the business process. And then the laggards are at a competitive disadvantage because they're not utilizing uh, technology to their benefit. It's this very similar in investing. Those early adopters of things like trend and defend are going to get the more benefit and be ahead. And then some point, a lot of people are going to be using that. And then those laggards that aren't using those defensive methodologies or alternatives, those kind of things will be, at a competitive disadvantage on the back end of the bell curve.
Yeah. So you've got some great strategies for creating a portfolio with different asset classes, and it sounds like a great strategy, Chuck. One thing I was wondering, what are some of the common mistakes that the average investor makes? Is it not properly diversifying, or like you've described, or what would probably be your biggest mistake that you see investors make?
Yeah, great question. And I think it is non-diversification, either that and or over diversification. Feeling, and I say over diversification, they can have 10 stocks, but they're all very correlated. They're all in semiconductors, for example. That's not diversification. So you got to be very cognizant of how you're diversifying and how things are affecting each other. And then not having stop losses, not having a point where I say, you know what, I've had a nice profit. I'm going to lock some of that profit in, uh, and keep some of what I've earned along the way. And the other is people think they have to be all in or all out. It's no, you can sell 25% of it, trim your position, manage, take some of that off the table. And, it helps you diversify and get to a sleeping point a little bit better.
Yeah. So we talked about being defensive. So why do you think that defensive strategies are so valuable?
Well, just that it helps balance the overall portfolio, right? If you got a position that's going down, you got something, a balance point that's maybe going up, and it's just smoothing out your overall returns, which, as I mentioned earlier, is important. Not getting overhyped, right? So that's the defensive. I saw the other day Jim Cramer, who many people know on CNBC. had a list of 9 stocks in late 1999. 9 stocks that he said, here's the stocks for 2000. Third of them went out of business. Several were acquired. The best that one did, many went to zero. Several were down 90%. The best that one did was down about 55%. So trusting what people think are the experts on TV, just because the guy's on TV doesn't make him smart. He got that very wrong, got caught up in the hype of the internet bubble. And a lot of those companies didn't make it that he was telling people to invest in. So you just got to be careful. Just because he's touting it on TV doesn't mean it's a good investment.
You know, you're very math oriented and very logical. And I know you've done work with algorithms. Can you talk to us a little bit about the algorithms that you've developed? And, you know, how does that all work? It's hairy math, isn't it?
Oh, it is. And I do, if you want to put people to sleep, we can get into that and talk about exponential moving averages and moving averages, the convergence and divergence on things like relative strength and truth strength indicators. I pour over data, and there's times I'm talking and people say, I don't have any idea what language you're speaking. So I probably should just end it there and say, you know, I studied statistics through Harvard. I didn't get my MBA, but I dive deeper into math and quantitative things than most people.
But it's all part of your strategy, and that's Trend to Defend is based on much of that math.
Correct. It's very math driven and data driven strategy.
Great. Well, good. Well, we're coming to the end of our discussion here today, Chuck. It's been really fascinating. You've got lots of experience, and folks would be certainly, you know, very, very well taken care of working with you. Defensive strategies, really unique things that you do, Trend and Defend. It's all really great stuff. Is there, now that you have the floor, and, you know, we're going to have a lot of investors see this, a lot of advisors see this, and over the next year or so, maybe another 1,000 advisors are going to see this interview. Is there a message you'd like to send the advisor community that's going to see this? Because we're all here to learn, right? Is there anything you'd like to share with them about your success and how they can have success in the industry?
Well, yes, I don't take much credit. I am very fortunate, very blessed to just have the experience I've had in life. Just 2 great parents that helped shape me the way I am, the discipline, the quantitative, very analytical minds of parents. Most things were black and white. That's one of the drawdowns with me as well. But I'm just very blessed in that regard. If I always like learning, realize I can still learn a lot. So if there's things people have to share and I can help them in any way, I'm open. I'm very open about that. Try to be available for people.
Nice. Well, great. It sounds like you got a great business, as I said, and we're very fortunate to have had you today, Chuck, with us. So thanks very much with us.
Thanks for having me, Brian. I greatly appreciate it, and always a pleasure.
All right, folks, and Chuck Brokop is part of the FourStar network, and so you can call our headquarters and our website is fourstarwealth.com, and then of course Clearstream Advisors is in Arizona, and they're part of the FourStar network. So reach out to us on our website, and we're happy to connect you with Chuck. You know, that's it for today, everybody. Thanks, Chuck, for being with us. We will be back with another wonderful financial advisor, just like Chuck, maybe from the FourStar network, maybe not. But these are the great people in the industry that investors can work with to help them manage their finances throughout their life. And you're a great example of that, Chuck. Thank you.
Thank you, Brian. I appreciate it. Have a great day.
Thanks. You too. We're going to leave it there, everybody. Thanks for being with us today. We'll be back again shortly.